Welcome. I'm David T. Phillips, CEO of Estate Planning Specialist, and your host each Wednesday for Estate Planning Made Easy, the podcast that will teach you how to keep your wealth in the family. During our initial first 4 broadcasts, I covered in the first episode the difference between estate planning and financial planning. Now, they both work together, but they are extremely different. Financial planning is building wealth, accumulating wealth. Estate planning is distributing wealth when we pass away. So they work very closely together, but they are different. Then in my second podcast, I introduce you to the first of the 10 most common estate planning mistakes that I see time and time again. And these estate planning mistakes are ones that I see. There may be others that are out there, but the ones that I see time and time again. And the first mistake that I see is, of course, not having an estate plan at all. You see, without an estate plan, we create the worst emotions of humanity. She wanted me to have it. No, she wanted me to have it. You create hate and envy and jealousy. And that's not really what we want to do. Without an estate plan, we do this. With an estate plan, we can create harmony and joy and unity within the family. So that's the number one mistake that I see, is not having a plan. The second mistake that I revealed in the third episode was assuming that the government is in a neutral position with regard to estate planning. The government is not in a neutral position. They have taxes that they will employ if our state gets too big, if we live in one of the 17 states that have a transfer tax. They also will tax our pension plans, our qualified accounts that we have, and they will tax those at the current tax bracket of those inheriting those assets. So we need to plan for that and the fact that the government is not neutral. The third mistake that I see was introduced in the fourth episode, and that was assuming that portability is a good thing. Portability was introduced a couple of years ago, and it is not a good thing. And I warn listeners and viewers not to fall into the portability trap. So go back and listen to episodes 1 through 4 if any of those topics are of interest to you. Today, I would like to reveal what the fourth most common estate planning mistake that I see. And this mistake is a mistake that we could actually avoid with proper planning. And that is paying too much income taxes and capital gains taxes through the year. Given the fact that there are strategies that we can implement to legally lessen the tax burden, not only on us while we're alive, but on our kids when we pass away. If we lessen the burden to us, we will leave more behind. And we will actually have more for us to spend through our life. So the goal is to find investments that are not taxable as we grow the asset. So what assets would that be? Well, the first asset that I think of right off the bat is real estate and even stock appreciation. Because if we build these assets, if we buy the asset and we let it ride, if we buy the apartment complex or the duplex or the houses and we let them just appreciate in value, as long as those assets are not being used or traded in for cash, those assets will accumulate and compound tax deferred. They'll build and grow tax deferred. And that's pretty cool. Well, as we build that asset, though, we're also building the basis. Or we have an original basis that we have when we bought the property. So But when we pass away, we're passing away a larger basis, hopefully, because the asset has increased in value. So what I want to do today, right now, is explain to you what the step up in basis really is, because this is an important strategy to implement to take advantage of asset appreciation in real estate and stock. So let's say I have an asset that I bought, stock that I bought for $100,000. And let's say it's Bill has it. My name's Bill, and I have this asset that I bought for $100,000 stock, Microsoft or whatever, and now it's worth $1 million. So there's $900,000 in appreciation. If I were to sell that asset, let's say 10 years into it, I would have to pay capital gains tax on the $900,000 appreciation, correct? And so one of the reasons why a lot of people don't sell their assets is because they don't want to pay capital gains taxes. And if we live in states like California that have a very high capital gains tax on top of the federal capital gains tax, we have the two taxes together, and it certainly is a demotivator to selling assets. So we then have this asset that's appreciated from $100,000 to $1 million, and we pass away. When we pass away, at that time, the beneficiary, a non-spousal beneficiary in this case, receives a step up in basis. And so their new basis is $1 million. If the day after the funeral, they decide to sell that stock that I purchased for $100,000 that they inherited for $1 million, there would be zero capital gains tax and zero income tax on the transaction, be tax-free. So they would get the $1 million estate tax-free, and they would also get it in estate tax-free if it's under the exclusion, which we know today the exclusion is $13.6 million. So virtually any appreciated asset that we have that we leave to our beneficiaries is going to have that step up in basis. And that's a very, very valuable basis to have. Okay. So that's one of the assets that we want to have in our portfolio is real estate and stock because it appreciates. But we have to monitor it because someday we might need some of those assets for income. And there are strategies that we can implement that can lessen that income tax blow to us that we can talk, and we will talk in later episodes, especially when we have some guests on. Okay, the next asset that I want to talk about that we can purchase is precious metals. Precious metals can go up in value. Now, if we're going to sell precious metals, we actually pay a higher capital gains tax than we do if we were selling real estate or stock. But if it appreciates, so I buy $100,000 worth of bullion and it's worth $1 million when I pass away, they will get that step up in basis. And so that's pretty cool to do that. Another investment that we want to think about is deferred annuities. Deferred annuities, while they do not get a step up in basis, they do get tax deferral while they are accumulating. And Todd will, in a later episode, Todd, my son Todd, who's the president of Estate Planning Specialists, will explain what annuities are and how important they are in your portfolio. He's written a book that's called Future of Retirement Savings that I think you all should have. And so go to the website, Estate Planning Made Easy, EPMeasy.com, and order Todd's report, book. And then you also, in our monthly newsletter, Generational Wealth Strategies, Todd does a column each month called the Safe Money Corner, And in there, he lists the best annuities of the month. So subscribe to Generational Wealth Strategies by going to generationalwealthnewsletter.com. We'll put all this in the show notes, so you'll be able to have access to both of those. Or go to our website, which is shop.epmez.com. Then you also will want to read Todd's report called How to Create Your Retirement Time Machine. It's a very valuable report that he wrote specifically on annuities and how annuities can be helpful in your estate. So that kind of explains just a little bit about annuities. I don't want, the idea is that when you take money out of the annuity, of course, you have to pay taxes on the gain that you have, and the beneficiaries will have to do the same. So while it accumulates tax deferred, there still is a tax on everything that is not principal, unless it was in your qualified account, which is the next way to build money, tax deferred. And a qualified account is anything like your 401k, your IRA, 403b, which is a teacher's or hospital tax shelter investment. And also the 412E3. I see a lot of 412E3s out there. Deferred compensation, defined benefit plans, those are all qualified accounts. Now, a qualified account accumulates tax deferred. It is also a tax deduction for you. So you don't actually report it as income. So when you take it out, that is when you pay the taxes. You'd pay the piper at that time. You take out $1 to buy a candy bar. Ending on December 31st of that year, they determine what your tax bracket is, the IRS does, or your accountant does, and then they determine at that point in time what your taxes would be on that dollar that you took out for the candy bar. So if you're in the 25% tax bracket, on April 15th, you will have to give the IRS 25 cents for buying that candy bar back in January or February or March, whenever you took that dollar out. And that applies also to your beneficiaries because the money has never been taxed. So if a beneficiary inherits your IRA or 401k, your qualified account, they're going to have to pay taxes on it. And they pay taxes differently than you do. I wrote a report called The Bombshell Battle Plan. I didn't bring it in here today, but go to our website, epmez.com or shop.epmez.com and order the Bombshell Battle Plan. And in the Bombshell Battle Plan report, I explain all of the rules that are currently in place in reference to the taxation of this money to not only you, this deferred money, but to your heirs. And in 2020, there was a new rule that was introduced called the Secure Act. It was legislation that was passed unanimously by both the Houses and Trump. And in that legislation, it specifically showed that when the children inherit the IRA or the 401k, they have to not only pay income taxes, they have to pay those taxes within 10 years. All of the distribution has to be made 100% by all of the money that's in the IRA that's inherited by your kids. So your heirs are subject to those new rules, and you have to plan for that. But it's a good place to accumulate money. Well, another strategy that we can implement is a Roth conversion. And a Roth actually is a very, very good idea because in a Roth, you allow the Roth to accumulate tax-free, not tax-deferred. But to get the money into the Roth, you have to do what's called a Roth conversion. And we, as estate planning specialists, would be more than glad to show you what the impact of doing a Roth conversion on your IRA today and what it means to you personally. But once the money is in a Roth, it accumulates tax-free. But to get it in there, we have to pay taxes. And so we want to play what's called the tax bracket management game. And in that game, you basically try to get your income. Currently, I think the filing jointly $390,000, the most we would ever pay in taxes on that in federal taxes would be 24%. And that's critical, that's crucial, because that's way under what it used to be. And it may change here with the coming election. But for right now, for 2024, we have that tax bracket in place, that 24% filing jointly to 390. And in your show notes, I will have for you a table that shows you what the brackets are and how to play that tax bracket management game. But the idea is you want to convert as much money as you can from your IRA to your Roth. When the kids inherit your Roth, they also get it income tax free. Now, they do have to take it out within 10 years, but still they get it income tax free. And when they pass it, if they pass it to their kids, it's income tax free as well. So it's very critical that you set up this Roth. But I will caution you that a Roth is only worth what a Roth is worth. And that's kind of where we introduce to you today the family bank strategy. Because with the family bank strategy, I believe it's the Holy Grail of Roth conversions. Because as I said, if I converted $100,000 of my IRA into a Roth and I pass away the next day, how much is it worth? $100,000. Well, with a family bank strategy, I could take that $100,000 and leverage it to $1 million very easily. And in fact, in the show notes, I will have a table for you showing you what this conversion would do by taking some of your required distribution or just taking some of your assets and converting them into cash. And I'll give you a brief example today. So we have a couple who are 65 years old. And if they were to simply transfer their annual gift, which the gift is $18,000 or $36,000 for a couple, it will create a $3 million estate in a joint policy for their family. So that's the power of the family bank and accumulating and building cash tax-free. Now we're going to talk more about family bank strategies in future episodes. In fact, we're going to spend several episodes talking about family bank strategies, but I just wanted to introduce them to you today so that you know that is the ideal strategy that you can implement to avoid income tax while you're building this money. You avoid all the taxes as you're building it. And when it passes to the next generation, it's totally 100% income tax free and can be estate tax free if you set it up correctly. So that's all we have today. I want to just invite you that next week we will be talking about the proper way to use your gifting power. Each of us have this gifting power, and I want to teach you the proper way, because the mistake that I see most often is the inability to use that gift correctly. So until then, this is David Phillips signing off.